Dear students, this is the second set of video from third chapter of Indian economy, that is liberalization, privatization and globalization and appraisal. In the first set of video, we have already gone for the structural reforms, which were the long-term reforms as per the second economic policy, new economic policy introduced in 1991. Three steps which were introduced, they were liberalization, privatization and globalization. In present video, we are going to cover liberalization. You can see on your screen. As pointed out in the beginning, rules and laws which were aimed at regulating the economic activities became major hindrances in growth and development. From 1950 to 1980, the Indian economy was more inclined towards inward-looking policy. At that time, number of rules and laws which were made for the development of economy, presently they were creating hindrance in the growth and development. And liberalization was introduced to put an end to all those restrictions in various sectors of the economy. Though some of the measures had already been taken in 1980, such as industrial licensing, export-import policy, technology upgradation, fiscal policy, and foreign investment. But the present initiatives of 1991 were more comprehensive, were more enlarged. So we'll study them in detail, that by this liberalization, what were those areas and what was their impact in making the economic activities more liberal, more rules and regulations free. The first one, deregulation of industrial sector. Regulatory mechanisms were enforced in various ways in India. First, regulations were industrial licensing. In that, every entrepreneur had to get the permission from the government to start his firm, to close his firm, and by that permission only he could decide that how much amount and at what price could he produce his commodity. Second, the private sector was not allowed in many of the industries. And third, some goods were kept away from the competition. They were only fixed, they were only safeguarded for the small scale industries. And the controls on price fixation and distribution of selected industrial products. By these four ways, the industrial sector was completely regulated by laws and rules. So in 1991, the time had come when we had to remove all these rules and regulations. So in 1991, the reform policy abolished, removed all these restrictions. First, industrial licensing was abolished from most of the product categories. Few were still kept under licensing, such as alcohol, cigarette, hazardous chemicals, industrial explosives, electronics, aerospace, and drugs and pharmaceuticals. For these sectors, still that licensing policy continued. With rest of the products, it was completely abolished. Now, the control of the public sector was reduced, was limitized. It was kept open only for those areas where the private players cannot perform, such as defense equipment, atomic energy generation, and the railway transport. Rest all the sectors were privatized. Third, this controlling or safeguarding the certain products for the small scale industries was also removed. It was made disreserved. Now it was open for everybody. And the prices of the products were not decided by the government, they were decided by the market. These were the reforms which took place in the case of industrial sector. Second, in this new economic policy, financial sector's reforms also took place. Financial sectors means such institutions like commercial banks, investment banks, stock exchange operations, and foreign exchange markets. Before 1991, all these financial regulations were regulated in India by RBI, Reserve Bank of India. Till that time, all the banks and other financial institutions in India were regulated by RBI by different norms, by different regulations. RBI was only the bank which was deciding the amount the banks can keep with themselves. RBI only was deciding the rate of interest. RBI only was deciding how much money they can lend, how much loans they can give, what kind of loans can they give to different sectors. So, this controlling of this RBI working as a regulator was switched on from regulator to facilitator to the financial sectors. Now it was not working only as an obstacle, but RBI was reformed. The rules and regulations of RBI were reformed in such a way so that it can help in the development of the financial institutions. Further, the reform policies led to the establishment of private sector banks as a result, Indian as well as foreign. So in India, number of private banks came into existence. And for those foreign investment in the banks was raised up to 50%. 50% foreign share can be there for establishing a private bank. And those banks which fulfill certain conditions, they have been given the freedom to establish their new branches without getting the approval from RBI. Now the banks had to decide that in some area whether they want to establish one of their new branch, in what way they will maintain that branch, that was individual bank's decision. RBI was not controlling that. and the banks were given the permission to generate resources from India or from abroad. Now it was their look after to generate the money for themselves, right? To safeguard the interest of their own customers. Yes, to some extent, RBI still maintained that regulation so that the interest of the account holders and the nation could be safeguarded. Certain merchant banks, mutual funds, and pension funds, now they all were allowed to invest in the financial markets. So, this was a kind of investment in the establishment of foreign institutional investors. They were allowed to enter in Indian market and establish their business. This was the reforms in the field of financial institutions. Third, tax reforms were done. Mainly, the government's revenue is being generated from the taxation and the money which they generate from public sector enterprises. There are two types of taxes. One is direct and the other one is indirect. The direct taxes, they consist of the income of individuals as well as the profit of business enterprises. That is the first kind of tax which the government takes. And from 1991, the reform which was done in the case of taxation policy, there has been a continuous reduction in the taxes on individuals' income, as it was felt that high rates of income tax were an important reason for tax evasion. What was happening? Tax rates were very high, so people were not showing their actual income to avoid the taxes. So those tax rates were reduced. And as a result, what happened for this direct tax? People got encouraged for savings and to voluntarily disclose their income. Second, the corporation tax, they were also reduced. Any of the industrial sector which were producing and the profit which they were generating, their rates were also reduced. So they also started showing their full income and started paying to the government. These were the reforms which were done in the case of the direct taxes. In the case of the indirect taxes also, the efforts were made to make the indirect taxes also easier. Indirect taxes means taxes levied on commodities in order to facilitate establishment of common national market for goods and commodities. So this was another component of reform in this area is simplification. The method of tax paying was also made simple. One, the rates of taxes were brought down. Second, the method of submitting your taxes was also simplified. Also, to encourage the better compliance on the part of the taxpayers, the procedure was simplified and the rates were substantially lowered. And for that, recently, in 2016, goods and services tax was passed in the parliament, and from July 2017 it is enacted, which we call as GST. So this is also one of the reform by which this tax procedure is unified, simplified, so that the idea of one nation, one tax and one market could be achieved. Now, the reforms were done in foreign exchange area. Markets were opened for the foreign countries' products and to increase the competitiveness. In 1991, an immediate measure to resolve the balance of payment crisis was taken, and for that the rupee was devalued against foreign currencies. What was the benefit of this thing? This led to an increase in the inflow of foreign exchange. It also set the tone to free the determination of rupee value in foreign exchange market from the government control. That the value of the rupee in the foreign market was not being decided by the government now, it was depending over the market. The country which sends the more quality products and the products are in more demand, the value of that currency goes higher. So it was not regulated by government, but it was regulated by the market. And if a country is producing quality products and those products are in high demand, the value of that currency goes high. So these were the reforms which took place in the case of the foreign exchange. Reforms took place in the case of trade and investment policy. Liberalization of trade and investment regime was initiated to increase international competitiveness of industrial production and also foreign investment in technology into the economy. The objective of this liberalization was to promote the efficiency of local industries and the adoption of modern technologies. The objective was to help our own industries become more competitive and develop themselves by establishing modern industries, modern technology. The two methods by which the domestic products, the indigenous companies are protected were quota and tariff. Quota is a quantitative restriction on imports. It was completely abolished. And the tariff is taxes imposed on the imports. If the taxes are very high, the imports would be reduced. The products cannot enter in the market, foreign products cannot enter in the market, and they can't do the business in market. So for that, the tariff rates were also brought down. And this helped in developing the efficiency and competitiveness in the manufacturing sector. The trade policy reforms aimed at first, dismantling of quantitative restrictions on imports and exports. Second, reduction of tariff rates. And the third, removal of licensing procedure for imports. This import licensing was abolished except in certain cases, in some cases where the products may be hazardous and environmentally sensitive. For that, still the import licensing policy continued. Quantitative restrictions or quota was completely abolished from April 2001. The markets were open to supply the products as per their capacity. So that was one of the measures of enhancing the capacity build measure. Export duties have been removed to increase the competitive position of Indian goods in the international market. So these were the initiatives by which the Indian market was completely made liberalized, less regulated by rules and regulations, so that an a level playing ground could be provided to our industries, to our products, to make them more competitive, to make them more of better quality, so that the expansion of the market could take place. So this we have covered the liberalization. Now in the next video we'll cover privatization and globalization together. The structural reform which took place after this new economic policy of 1991. Thank you.